I did a recent survey on YouTube where I asked my subscribers to vote on what videos they would like to see next. So a big majority, or 40%, said that they want to learn more about high income strategies. So I want to thank everyone who participated in the survey. If you want to participate in future surveys, make sure you're subscribed to my channel. I truly do value your opinions on what you really want to see next, hence this video. So it's no secret, guys, that I love covered call ETFs. They make up the biggest percentage of my portfolio, and I consider them to be one of the safest and most efficient income-focused ETFs. So they are relatively new ETFs. The earliest ones that I've discovered on the Canadian stock market were created in 2011. So unfortunately, most people haven't heard of them or misunderstand really how they work because they can sound a bit complicated. So in this video, I will do a deep dive on the benefits and the features of covered call ETFs. I can promise you that by the end of the video, if you watch all of it, you'll be an expert on covered call ETFs, which were designed for one thing: safe, consistent, high dividend income. So to understand covered call ETFs, we need to understand what covered calls are. It's only logical, right? So I did go over this with a really long analogy in my previous covered call video from a few months ago, but I really want to focus here on the features and benefits. So I'll try to make this part as brief and concise as possible. So covered call ETFs use options to boost the dividend yield or the income you get without any added risk. So between two ETFs, let's say, that have very similar or identical holdings or the stocks inside the fund itself, the ETF that uses the covered call strategy will always provide a bigger dividend or a bigger dividend yield. So what are options? Well, it could sound really complicated and might take you a while to understand it, like me, but once it clicks, you're good. So I'll give it a shot. In options trading, which is very popular or more popular in the US, you can either sell a call option or a put option. So as you already guessed, covered call ETFs deal with call options. So what is a call option? Well, an option, first of all, is a right but not an obligation. So you have the options of who your friends are, what shoes you wear, and who you date or marry. It's a choice, right? Not an obligation, unless it's an arranged marriage, of course. But in terms of investing and the stock market, a call option is a buy option, whereas a put option is a sell option. So let's use an example. Let's say you own shares of Bell Canada. Right now, the stock price is about $55, right? As the owner of the shares, you can sell an option to another investor to buy the stock from you at a price that you both agree on. So the share price that you both agree on, by the way, is technically called the strike price. So by selling this option to somebody else, the person who you're selling it to has to pay you a fee, which is called a premium. Also, since it's an option to buy the stock from you, it's called a call option. Remember, a call option is a buy option. So for example, you can sell a call option to another investor for them to buy your shares of Bell Canada for $58, $3 higher than the current share price of $55. Now, keep in mind that there's always a time limit on any option contract. It's usually 30 days. So what happens after 30 days? Well, if the stock price of Bell Canada is under the strike price or the price you agree with the other person of $58, there's no way that the person who bought the option from you will buy the shares off of you for $58, right? Why would he? He could just buy the shares himself on the stock market for less than $58. So with this particular contract or with this particular transaction, the option becomes null and void. The technical expression is the option expires worthless. So worthless for him though, but not for you, because regardless of what happens after those 30 days, you always get to keep that fee or that premium from the potential buyer. The fee in this case is pure profit, and from a tax perspective, it's considered a capital gain. So you get to keep your Bell shares and you just made a little bonus. Fantastic. Now, what happens if the share price goes up really high within the 30 days? Let's say $60. Well, in this case, the person who bought the option off you will definitely exercise his option to buy the shares off of you. Why? Because the shares are worth $60 now and he can get them off you for $58 instead. As simple as that. So in this case, you have no choice but to honor the deal and sell your Bell shares to that person for $58. So what does this mean? Well, two things. Number one, you had the shares at $55 and sold them for $58. So you made a small profit of $3 per share. Number two, you still get to keep that fee or that premium the buyer paid you at the beginning. So you might be thinking, okay, well, what's the bad news? Well, the only bad news is that now that the stock price is worth $60, so you missed out on some share price upside, $2 per share to be exact, right? But did you lose any money? No, you didn't. You just gave up some share price upside. That's all. But keep in mind that this worst case scenario, which isn't that bad if you think about it, only happens if the share price goes up significantly in that 30-day period. Now, another thing I want to point out with the example I just went over is that this was an out of the money call option simply because the price or that we agreed on in the contract was higher than the current share price of $55. If the strike price or the price you agree on in the contract was $55, let's say, the option would be considered a at the money call option. That's simply because it's at the same price as the current share price of $55. So if you sell at the money call options, there is a much bigger chance that the option will be exercised, right? Because the share price just needs to increase by 1 cent, whereas in the first scenario, the share price needed to increase by at least $3. And of course, this is within the 30-day time frame. But when you sell at the money call options, the fee that you get or the premium is much higher simply because there's a greater chance you will have to sell those shares. So a juicier fee, but you sacrifice all the potential share price upside. So that's basically how selling a covered call works. So why do they call it a covered call? Well, it's simply because you own the Bell shares in the first place. So in case the option gets exercised, you're already covered. You'll be able to fulfill the transaction. As simple as that. Now you might be thinking, well, this sounds really complicated. It would take so much time to do this every month on your own with your own stocks, right? I completely agree with you, and this is where covered call ETFs come in. The actual work of selling these call options every month is all done by the fund manager. It's all transparent to you and me. Isn't that great? Of course, it's not free. It's part of the management fee that they charge for the ETF. That's why covered call ETFs have slightly higher management fees than non-covered call ETFs. It's only normal because they got to put more work into it, right? But it's very, very worth it if you ask me, because covered call ETFs give much higher dividend yields. And just a side note about management fees in general, guys, as I keep getting a lot of questions regarding this, you don't actually have to pay the management fee yourself like once a month or at the end of the year or anything like that. It's completely transparent to us. It's already included in the fund, so you don't have to worry about them. It's basically like when you go to an all-inclusive resort. Now, every fund manager has their own covered call option strategy. Let's check out two of them real quick. Now that you understand how call options work and some of the terminology, it will be much easier to understand what these fund managers are talking about. And after that, I'll review the 8 benefits that these covered call ETFs have. Alright guys, so I'm on the homepage of my website. I'm here because if you click on free tools and resources, you have a bunch of free stuff that you could download and look at, like my portfolio, like my RRSP portfolio, etc, etc. But if you scroll down all the way at the bottom, I actually put the links to my favorite covered call ETF managers. You have Harvest here, BMO, CI First Asset, and you have all the links to the document which actually describes their strategy in detail. So let's start with the CI covered call strategy first. So as you can see here, CI covered call ETF strategy generally consists of an equally weighted portfolio of companies targeting a sector or segment of the market. And here's the key: while writing monthly at the money call options on a maximum of 25% of the portfolio. See, now when you read at the money, you'll know exactly what they're talking about, right? What about BMO? Well, in BMO's document, which is pretty long because it actually goes into what the covered call strategy is all about, which I explained to you. If you scroll down, you'll see their strategy here in detail. OTM, which stands for out of the money call options, are sold on approximately 50% of the portfolio depending on market conditions. So this gives the investor an enhanced yield and still allows for participation in rising markets. So there you go. So there you go, guys. The two important things to take note when you read a particular fund manager's strategy, a covered call strategy, is one, what percentage of the portfolio do they write call options on? And number two, are they out of the money call options or at the money call options? So that is actually called the moneyness of the call option. So is one better than the other, out of the money, at the money? Personally, I don't think so. They're just different. That's how I see it. The goal is really the same, guys. It's to make more income while still making sure the ETF share price can grow or has room to grow, although it's at a reduced rate. So what are the benefits of owning covered call ETFs long term? Why would somebody own a covered call ETF versus a regular index ETF like VCN by Vanguard or a regular dividend ETF like VDY from Vanguard? I identified 8 of them, so let's go through them one by one. Benefit number one, and this is a no-brainer, they have higher yields versus regular ETFs. So this one nobody can dispute, right? Covered call ETFs will always beat index ETFs or regular dividend focused ETFs when it comes to the income. When it comes to the income, I just want to be specific on that. I've been looking at this stuff for years, guys, okay, comparing, watching different ETFs. Covered call ETF annual yields are always at least most of the time 3% or more higher than a similar ETF that has the same stocks in it or the same holdings, but that doesn't use a covered call strategy. So a perfect example is ZWC versus ZDV. Both ETFs hold top Canadian dividend stocks, but ZWC has an annual dividend yield of 7.9%, where ZDV has one of 4.6%. So that's a huge difference. Well, what about the management fee? Well, ZWC has a management fee of 0.65%. ZDV has a management fee of 0.35%. So I don't know about you, but I'd rather pay 0.3% higher management fee to get an extra 3.3% in annual dividend yield. Benefit number two, covered call ETFs have great performance during volatility and stock market crashes. So I love this benefit. This is where the psychological benefit is. Remember those fees or premiums we get from selling those covered calls? Well, when there's stock market volatility, that's just a proper way of saying when things go to hell. So we're talking about a big and sudden economic disruption, which always leads to a stock market crash like 2000, like 2008, and of course 2020. So during those scary and anxious times, the price of premiums or call option premiums go up substantially. That's right, volatility is good for covered call ETFs because they can generate more cash with those covered calls. That's why whenever you read a description of a covered call ETF, you usually see something like call option writing reduces volatility, or covered call ETFs have a degree of downside protection. Sleep like a baby during stock market crashes. I rest my case. Benefit number three, covered call ETFs are an easy way to diversify a portfolio. So covered call ETFs are still, well, ETFs, right? Which are just a basket of many stocks. So covered call ETFs come in all kinds of shapes and sizes. Some focus on different regions, like the BMO covered call ETFs, which I love. So ZWC covers Canada, ZWE covers Europe, ZWS covers the US, etc., etc. But then you also have sector themed covered call ETFs like TXF, which covers technology, or HHL, which covers healthcare, etc., etc. So the point is, you could easily have a very diverse or balanced and diversified portfolio only using covered call ETFs. Benefit number 4, you have 2 income streams instead of 1. Now, this is huge. So what are the 2 income streams? Well, number 1, the dividend income from the stocks inside the ETF, and number 2, the option premiums. This simply means even more safety because dividends can always get reduced or cut, although that's very, very rare, especially when we're talking about big blue chip companies. So having another source of income, which is infinite, is a huge bonus. Why infinite? Well, as long as options are being traded, there will always be option premiums to be made. It's that simple. Benefit number 5, they provide a safer and more consistent income versus single dividend stocks. So a major lesson that I learned in the 2020 COVID market crash is that individual stocks are way more at risk at reducing their dividend or cutting their dividend than an ETF. It's a no-brainer simply because the ETF holds many stocks, right? So if 1 or 2 stocks in the ETF go bad or cut their dividend, well, it's not a big deal if the other 33 stocks are fine, right? So the income is by definition safer and more consistent compared to single dividend stocks. Benefit number 6 is that the management fee is very low for what you get. Many people pay way too much attention to management fees, in my opinion. They just try to find the lowest one possible. But listen, a 0.65% management fee is nothing when you consider the benefit of what you're getting, the really high income, right? Of course, they will be slightly higher than a non-covered call ETF, but there's a lot more work that goes into them, so it's only logical that the fee is higher. If you ask me for what you're getting, the management fee is actually pretty low. It's much lower than an actively managed mutual fund, for example, where the fee can easily be 2% or higher. I rather have my fund manager sell covered call options and make guaranteed income instead of actively trying to beat the stock market by buying and selling. Wouldn't you? Benefit number 7 is that covered call ETFs offer a passive, hands-off strategy. So I'm a passive income investor. I want to be as passive and hands-off as possible. I don't want to care about what the stock market is doing day to day or decide when to sell something to make a profit. I basically want to own a cow that milks itself and that doesn't need to be fed. And that is exactly what covered call ETFs are. You buy them, you hold them, and you forget about them. The only work that you'll have to do is transferring the money from your broker account to your bank account. It takes about 6 seconds every month, and honestly, I have to say, I enjoy every second of those 6 seconds. Last but not least, benefit number 8, covered call ETFs provide tax-efficient income. So here's another great one. You remember all those premiums we get by selling covered calls? Well, those premiums are classified as capital gains and not eligible dividends. Capital gains are taxed much better than dividends. Of course, none of this matters if you hold them in a TFSA or RRSP, but in a regular cash account, it does. It means more money in your pocket instead of the government's pocket. As simple as that. So great benefits, right? What about the downsides? Well, there's only one. You're potentially sacrificing some share price upside. So I stress the word potentially because it's when the stock market is in a strong bull mode or when stock prices are going up dramatically that covered call options that the fund manager sells would be exercised, right? In a flat or downward market, it's all free money. I also stress the word some because like we saw earlier, the fund managers only sell covered calls on a certain percentage of the portfolio, not the entire thing. So what does this mean in practical terms? Well, it means that in terms of share price performance over the long term, covered call ETFs will never beat an identical ETF that doesn't use the covered call strategy. But if you're a buy and hold investor focused on passive income like myself, the last thing we really care about is the stock price going higher, right? Because we don't intend to sell the shares anyway. We simply want to maximize our passive income every month so we can live a better life now instead of later. So the $1 million question, right? Why were these ETFs created? For who were they designed for? Well, these ETFs are specifically designed for investors who are looking to get maximum cash flow or maximum income without any added risks like leverage, for example. They are perfect for passive income investors like myself who just want to buy and hold, that don't want the hassle of deciding when to sell a stock to make a profit. I'm up 20% on this stock. Should I sell it? Should I wait? I don't want that stress or anxiety. I want it simple and easy. I want maximum income every month, and I don't want to be worried or care about what the stock market is doing. So the fact that covered call ETFs actually perform better during stock market volatility and crashes is a huge psychological advantage and very underrated if you ask me. Imagine not caring about what the stock market is doing, consistently getting income every month regardless what nonsense is happening in the economy. Covered call ETFs can give you that peace of mind. They are a perfect fit for retirees because retirees want cash flow. They want income. They don't want to think about when to sell shares. They want to enjoy the rest of their lives in peace and happiness. Covered call ETFs not only provide stellar, consistent income, but also peace of mind. They were designed to buy and hold, not buy low and sell high. If you want to play that game, you're much better off investing in individual stocks or the growth stocks or going to the casino. Most of the critics of these ETFs always say the same thing: the stock price trend is not good. And they're right. But listen, my friend, I don't care about stock price trends. I don't know how much clearer I can make it. Why would I if I don't intend to sell my shares anytime soon? Why would I ever sell my shares anyway if it's giving me income every month? Think about it. If you have a covered call ETF that's giving you 7.5% dividend yield a year, which means you're making 7.5% interest a year, right? By the way, 7.5% is actually pretty common with these ETFs. After about 13 years, you make all your money back or your initial investment back in dividends alone. Every dividend payment after that, as well as how much the stock is worth, is pure profit. And what have you done for 13 years? Nothing. What have you relied on to make all your money back? Nothing. All you need to do is stay alive. So over the long term, can you make more money being a growth investor? Of course you can, but you're depending on the stock market to go up so you can sell your shares at a profit, right? You have to decide when to sell. You will be constantly looking at the stock market, at the share prices, and you will poop your pants when the stock market crashes, because the only way to make money is that for the stock price to go up. Us, on the other hand, depend on nothing except time itself. We're free to enjoy our lives and use the consistent income we get every month to live a better life now, not later. And as we all know, life is short. And listen, if ever you don't need the income now for whatever reason, you just want your money to grow and have it grow for the long term, well, you could just turn on the drips. All those high dividends will automatically be reinvested to buy more shares, thus creating a compounding interest effect. These ETFs offer this flexibility where you could grow your money substantially and consistently with the income, whereas a mainstream index style ETF does not have this flexibility because you can only make money one way. The share price has to go higher. So what do you think about what I'm saying, guys? Do you understand how the covered call strategy works? Is something still not clear for you? Let me know by dropping me a comment below. Please visit our website, guys, passiveincomeinvesting.ca, to access my first ever digital product that I'm very proud of. You all seem to be enjoying it very much. I know I still use it every day. The Ultimate Dividend Passive Income Investing Package, which includes a huge list of ETFs, split funds, income funds, high-yielding single REITs and single stocks, with my personal comments for each one, all the stocks you ever need to build your own portfolio. Also, keep in mind that if you purchase the product now and we come out with an updated version later on, you will get the updated version for free. You won't have to buy it again, so don't worry. Also, on my website, you could book a one-on-one video call with me or consultation if ever you want me to answer any of your questions, review your existing portfolio, or help you to build a custom-built portfolio for yourself. Whatever your needs are, guys, I will do my utmost to help you and answer all your questions. I've done many of them, and I'm actually getting very busy with them, so it's great. It's great to meet new people. I love helping everyone. As always, please support us. Please support this channel by hitting that like button. It's free for you. It helps the channel out, so it's a win-win. And finally, make sure you're subscribed so you don't miss out on my future content and community posts on passive income investing, which is really all designed to help you on your investing journey, which we're all on together, guys. We're also on Instagram and Facebook, so join us there if you have those. Our mission remains the same. It's to help everyday working Canadians to invest on their own in order to build their own stream of passive income, their own paycheck, in order to enhance your quality of life. So with that, take care, guys. Stay safe, of course, and see you next time.